I'm Marella Fernandez. Thanks for joining us and welcome to Market Call. Chris Blumas is on the show today. He's portfolio manager at Raymond James Investment Counsel. And today he's taking your questions on North American large caps. Here's how to reach us. 1-855-326-6266 if you want to phone us and ask your question live. You can also send an email to marketcall@bnnbloomberg.ca. Chris, thanks for coming in today.
Thanks for having me.
The Bank of Canada, of course, just announced that it is holding the key lending rate. I was just wondering if you had expected a hold, or were you in the if there could be a cut pile?
I was leaning more towards there could be a cut. If you look even to just what the comments that came out, what a wide range of potential outcomes. We could have lots of inflation. We could have a recession. And so I think in the end, what the backward-looking economic data looks reasonable, right? If you look at inflation and things like that. But the forward-looking data, when you look at employment, doesn't look good at all. So I just thought, there might be some overweighting to the employment situation, just given the uncertainty created by U.S. trade policy, that would kind of keep the Bank of Canada cutting, because they'd cut it was 7 or 8 prior quarters. Mm-hmm. Given that there's such massive uncertainty, that also just that amount of uncertainty that the Bank of Canada is dealing with, businesses are dealing with, consumers are dealing with, everybody's dealing with, and that forces people to sit on their hands. And so, a little bit more relief on the interest rate side might help to provide better economic support. So I was more leaning towards the cut, but I don't think this was a surprise. I think from what I saw, it was about 50-50 of what people were expecting. The
bank says forecasting is pretty much impossible to do, given the fact that there are so many different factors that could affect what's happening in the rest of the year. I'm wondering if you're seeing that theme for businesses as well, where they are handcuffed as far as trying to do forecasting or plan ahead for the same reasons.
Well, I think so. And if you just think of kind of what goes on within, companies' boardrooms in terms of capital budgeting, when there's this much uncertainty, how could you bring up for approval from your board, a massive project? Such a thing as just forces everybody to sit on their hands, because there's nothing really you can do. You need a lot more certainty before you allocate capital, and until you get that, which is going to take some time, it's kind of a wait and see. And then the wait and see, doesn't help the economy. So I think, you are seeing it more and more from companies, but, and I think that even flows through to what I mentioned earlier, just from the employment side. Companies invest in people as well. And now you're seeing companies kind of, going the other way with some layoffs. So I think, all that uncertainty just creates an environment where it's hard to do anything.
Okay, we are going to take a quick break. We'll talk about how to navigate investment at this difficult time when we come back. We're going to be back with Chris Blumas, portfolio manager, Raymond James Investment Counsel. Your questions today on North American large caps. Back in a moment. Welcome back to Market Call. Let's go to an email from Stella. She says, please give me your thoughts on Dollarama. Is it a good time to buy? We'll pull up that chart in a moment, Chris, but what are your thoughts on Dollarama? We think it would be a good time because, of course, we might be headed for a recession, but then China.
Yeah, I think this is one, if you're looking to buy it now, I wouldn't. This is, like the uncertainty that I alluded to in the beginning of the show, Dollarama, Costco, they've been primary beneficiaries of this. As a result, the valuations have come up dramatically. So if you look at Dollarama, absolutely wonderful business, really, really well positioned, with their price points to kind of capture, a larger portion of the consumer wallet in tough times. So, right in the right spot. But the market's anticipated this. And if you look at the valuation, it's north of 35 times earnings. So I think, this is one you don't want to chase right now. They alluded to in their last conference call that they are going to suffer a little bit just in terms of sourcing from China. The margin impact has yet to be seen. But I think the end thing is they're in the right spot. I think just the valuation's a bit too rich. And then that kind of belays the risk, right? There's a lot of risk that the multiple could contract over the longer term.
Got it. Okay, let's go to the phone lines. Costa is on the line with a question from Montreal. Hi, Costa.
Hello, my friends. Thank you for taking my call. Mr. Blumas, I would appreciate your wisdom and knowledge on a beautiful company, Franco-Nevada Corporation. Are you bullish on gold this year? Thank you very much, and perhaps a price target. Have a beautiful day and happy Easter. Thank you.
Franco-Nevada.
Yeah, thank you very much. I think this is another one, very, very topical, right? I think in terms of where people are going to with all the uncertainty in the market, gold's been a huge beneficiary, right? And so I think in terms of, I've mentioned kind of in prior times on the show where you might want to go in the space. The streamers are always the kind of the preference. And so, Franco-Nevada, that's essentially what they do. They don't take the operating risk, but, they benefit from appreciation in the gold price. And then as more projects come on, the thing is, I think this is one, the valuation is very, very rich, and people run towards gold in times of uncertainty. And I think, it does make logical sense to have something like this in your portfolio. But I think the benefit in your portfolio for periods of time like now is this is a name that if you did own it, that would have appreciated quite significantly, can provide a source of capital so that you can recycle and buy things that are a little bit more undervalued. So, I don't know, my longer term view on the gold. Like I think this morning gold just hit an all-time high. So, I don't have a price target in terms of where I think gold is going. The gold price is highly correlated to volatility. And as you've seen the VIX spike, the gold price has come up. At some point over the medium term, if you see things moderate, as you see more certainty kind of come back to markets, the gold price will moderate. So to me, I think, if you're in this or you want to buy it, it's kind of like a shorter term momentum trade. That I'm not a specialist in that kind of investing. I think, the gold price has run pretty hard right now. I would look to be reducing some exposure and recycling back into some more beaten up names. So this is one that I do like, but I wouldn't chase it here.
Okay, let's go on to another caller then. Joe's on the line from Montreal with his question. Hi, Joe.
Good morning. Hi. I want to ask your guests about I presently have TD Bank and also Bank of America in my cash portfolio. I'm retired. Would he add to either position right now, and why? Taking into account, of course, the currency exchange rates and the future for both these banks. Thank you.
Thank you. So TD Bank, I haven't looked at it lately, but there was talk about trying to dip in when it went lower because of what happened last year when they got penalized in the U.S. Let's take a look at where it is now. But what do you think of investing in it at this point?
Yeah, so this is one, this is one I've talked about in the past. I do like TD a lot. I do own it in client portfolios. I do think that it is very undervalued. And over the medium term, there's potential for the multiple to re-rate. If you look at the valuation between TD and Bank of America, they're both trading at very similar valuations, about 10 times earnings, right? So I don't think that, in terms of kind of the earnings upside, TD has more earnings upside just because of the overhang from the regulatory infractions in the U.S. And so I think, from a Canadian perspective, why you'd want to own TD versus Bank of America, I think is there's a little bit more upside on growth. There's potential for a multiple re-rating. That'll give you, hopefully over the medium term, a better total return. The flip side is if what was expected in the U.S. is that, banks were going to be a little bit less regulated and be a little bit more open, that would bode well for all of the U.S. banks. The thing is, some of the large ones are already so large, so I can't see them being allowed to,
get even bigger.
To get even bigger, right? Then you're back to the same thing that they were trying to prevent in the past. So my preference here would be for TD over Bank of America.
And do you think TD has sufficiently responded and moved on from what happened last year?
I do, and I think, like TD, the ultimate kind of bank whipping boy right now. They've responded very well. This hit them at a really good time. They had massive amounts of excess capital. So I think, if capital was a little bit lighter and this forced an equity raise or a dividend cut, but if you look at this happened to TD at a really good time where capital was really robust. They've been able to increase their dividend in the face of it. They've been able to increase, their share of buybacks, and they've made some changes to their management team to kind of appease investors going forward. So I think they have sufficiently addressed it, and now it's just kind of a wait and see.
Okay. Let's move on then to another phone call. This one is from Faisal, who's calling from Toronto. Hi, Faisal. What's your question today?
Hi, good afternoon, Marilla and Chris. Thank you for taking my call. Chris, in this very uncertain and turbulent time, it's good to have you on the show, a voice of reason, steadiness, and calmness. My question is on Restaurant Brand. It has sold off from the high 90s to mid 80s. Can I get your thoughts on it? Would be a good time to take a position in it. I know they're reporting on May 4th. I'll hang up and listen, and thanks again. Bye-bye.
Restaurant Brand seems to be doing pretty well.
Yeah, and I think this is, kind of the lens that I look through at kind of companies. The first thing that I look at is kind of business economics, right? And Restaurant Brands has good business economics. They have really, really strong brands. They generate a lot of cash flow. The hang up for me, and why I don't own it, is just the balance sheet, right? They aren't investment grade. And so in terms of my process, I don't invest in anything that doesn't have an investment grade balance sheet, because in times of turmoil, access to credit markets could be restricted. And also for a larger cap company that doesn't have an investment grade balance sheet that is acquisitive like Restaurant Brands, say a big trophy asset comes up. If you don't have an investment grade credit rating, there's not access to capital in the debt markets to go out and win that acquisition. So I think, they've talked about over time, transitioning more towards investment grade, but it's not there now. And so I think that to me puts them at a little bit of a disadvantage. And so that's why I don't own it. I think there's lots of value there. It's about 16 times earnings. If you compare that to, what the US, what McDonald's, what, Yum is trading, it's a massive discount. So I think that, there is some good value there. So if you don't have the same hang up on the balance sheet that I do, I think it's a reasonable investment. The one thing that I would kind of caution people on, just as the economic situation gets tighter, more discretionary, things like what they do could get hit.
That's what I was going to ask you. I mean, I'm of two minds because they have very affordable menus.
They do.
And people turn to that, but they also want to cut their discretionary, and that could be one of the things they cut immediately.
And it wouldn't be, like you said, there is value. It wouldn't be something people want to cut, but what if it's something people have to cut? And that, to me, is tied to kind of employment. As you've seen, Canada, unemployment ticking up. U.S. unemployment ticking up. Any discretionary items will be impacted. And then you have to do more discounting to kind of keep that going. And then the margins kind of aren't there. So I think, from an economic perspective, there's a little bit of, I'd watch and wait. And then the balance sheet is kind of my hang up.
Got it. Okay, Chris is sticking around, of course, to take some more of your questions. He's portfolio manager, Raymond James Investment Counsel. Back in a moment. Welcome back. Thanks for joining us on Market Call. We want to get right back to your phone calls. Dominic is on the line from Montreal. Hi, Dominic.
Yes, hello. Thanks for taking my call. I'm calling on Nvidia, Chris, and while one hand is tied behind their backs on their restricted sales to China, their other hand is on their order book, which is probably full on the more advanced chips to here domestic customers. I wonder, Chris, what you find is this a good company to value by price-earning ratio? And what price-earning ratio would they be at fair value? Do you see good value here, or are you staying away?
Okay, so people are split on tech, right?
Yeah.
Because of the big fluctuations, and they just got hit, just to widen it out for people, Washington has decided that companies like Nvidia cannot send these AI chips, some of them to China, in this trade war with China. It's going to be a $5.5 billion hit for this company that has already sort of toppled quite a bit this year. Do you still dip in at this point now where it's $104, which we would see as a decent deal, but with tech being where we are, would you still dip in?
Yeah, so I think, the broader money flows out of tech, like I would use that as an opportunity to enter tech. And so, I have. And so I think in terms of, kind of some of the names, I don't own Nvidia. The name that I own and that I've used in client portfolios is Taiwan Semiconductor, right? In terms of kind of Nvidia, I love the business. It's a design business. So if you look at its financials and its business economics, they are phenomenal. They're very, very similar to a software company. So in terms of a metric you want to look at for Nvidia, I don't think price earnings is the one you want to go with. Just look at free cash flow. Free cash flow and then free cash flow yield. Look at price to free cash flow and then invert that to free cash flow yield. This is a business that gushes cash, right? And even with these restrictions on their redesign, or they made some slight changes to a chip to basically get around the export rules.
The earlier export
rules,
rules, yes.
And the thing is, and then the government clamped down. No, even the reworked can't go. Yeah. Okay, fair enough. They took their charge. But I still think, if you look at kind of domestic demand and say demand ex-China or ex-Asia, it's still quite robust. So I think even, growth at a reasonable price, I think Nvidia is quite reasonable here. The flip side is that in what always I always had a bit of caution on Nvidia is just, a lot of their customers are looking to get into the design business themselves. You've got Apple, you've got Google, you've got Microsoft, you've got Amazon, you've got all the biggies that are looking to kind of vertically integrate and design their own chips. Longer term, that comes away from Nvidia, right? And so I just think no matter how the future unfolds, it flows through Taiwan Semiconductor. And I think strategically for me, the location being in Taiwan, to me, it just seemed to have a lot less risk. And so I think if you look at the valuation and the growth profile of Taiwan Semiconductor, both, it's quite good as well. Valuation is significantly lower than Nvidia. I think even if I would have gone back in hindsight, those were the two that I had on my watch list. In the end, I went with Taiwan. I'm largely indifferent. I think it could have worked out either way. And so, if it's one you've kind of had your eye on for a while, I think I would use this pullback to add or enter.
Got it. Okay, let's get back to the phone calls. Andrew is on the line today from Winnipeg. Hi, Andrew.
Hi, can I get Chris's opinion on Enghouse, please?
Okay, let's talk about Enghouse.
Yeah, so this is one I've talked about Enghouse in the past. So this is a software company, so this is an enterprise software company, very, very acquisitive, and really not getting much love in the market. In terms of its valuation, its free cash flow yield, it's orders of magnitude, cheaper than almost anything out there. The thing is, it just keeps getting cheaper. I think in terms of their communication with investors, their balance sheet management, they're holding a massive amount of excess cash. And even if you look at historically what they've deployed, it's an amount of cash that, it's unlikely to be used. So I think in terms of their shareholder friendliness, they could increase the dividend, they could buy back shares, they could, have more efficient communication with investors. I think that's what's kind of put Enghouse in the penalty box. So the thing is, it's not one that I think I would just look elsewhere right now.
It's just not being paid attention to, and you don't think that's going to change.
I do. I think it's, value tends to not work in tech. I think, in hard asset businesses, the value, you can have a value thesis and things can re-rate. I think in tech, it's very, very hard in technology. Technology, I think the best you can do is kind of a GARP, growth at a reasonable price, because, value tends to tell you a lot in tech, what the market thinks of the prospects. And then given the size of the company, it doesn't capture any index flows and things like that. And I think, with more than half of the market kind of passive indexing, when you're not in front of that flow of money, it's really hard to kind of right size the valuation. So I think this is one I would just leave alone and look to buy, especially in times like this. This isn't a time in the market where things are fairly valued and you might need to do a little bit of value just to avoid buying something that's overvalued. Like, you can buy great stuff now at a really fair price. So I would focus on that and just leave Enghouse alone.
Got it. Okay, let's get back to the phone lines. Rena is calling on the line from Bathurst, New Brunswick. Hi, Rena.
Hi, I'd like to have your take on the Air Canada stock. I bought a few during the dip last week, and I'm wondering, as a long-term investment, if it's still a good choice.
Thank you. Okay, let's take a look at Air Canada, which has been sinking and sinking. It's well down below what it was in COVID times, right? I think it went down to something like 18 or under that, and we're now at 14.10.
Yeah.
What is hitting? I mean, obviously, there's a question about forward travel, given the circumstances of the economy. But what else is dragging Air Canada down, if there is something else that you see?
No, that's it. It's just generally, this is one of the most economically sensitive names someone could consider buying, right? And I think if you're considering buying Air Canada right now, you're saying to yourself, okay, you have to have a rosy economic outlook. And, prefacing that with what we heard from the Bank of Canada today, a whole lot of uncertainty. And a whole lot of people sitting on their hands and avoiding travel. I think it doesn't bode well for Air Canada. So I think, in terms of the valuation, it's come down massively. It's a business with such high fixed costs that it's so, it has such huge operating leverage. When travel slows down, it massively hits the bottom line, and they generate big losses. Their fiscal, their balance sheets get strained. And so the thing is, this is not a business I would look at right now. I think you can find better businesses out there, and I would just stay away from this, because this is kind of just right in the face of a recession, right? Like, it just doesn't offer you enough defense.
And if it does go up, it'll be a while before it decides to move back up if people are interested in traveling again.
It will, and I think just the way, what has happened now with U.S. trade, like, there's not a quick reset from that. This is a big issue, and it's not a, hey, mea culpa, hey, let's get back to it. Like, COVID was like, demand was just building and building, and the moment that, people could go places.
We were set free.
We were, it was like being in jail and then you're allowed to go.
Yeah.
This is totally different. There might be people that, are going to just change their travel patterns going forward. And so I think this has a much longer tail to it. So I don't think there's any reward to being on the front end of it. I would just watch and wait if you really want this one.
Got it. Okay, we are going to take a quick break. When we come back, we're going to have a look at Chris's past picks. That's next. All right, time now for past picks. Chris Blumas picked on April 2nd, 2024, so a year ago, the following. CGI, at the time, it was $148.20, and now it's gone down to $144.48, so a 2% drop in return and total return as well. What's going on with CGI?
Not much. CGI is an IT outsourcing company, so, really kind of on the front edge of kind of companies embarking on digital transitions, right? So this isn't going to stop, but it is a very labor-intensive business, and what you're seeing is just with uncertainty, kind of bookings, and there's a little bit of pullback, but wonderful business, kind of a global enterprise, very, very reasonable valuation. So I don't think there's any cause for concern here. So this is one I do like and would continue to buy here. Okay, let's move on then to your second pick from last year, which was Yum China on the New York Stock Exchange, recommended at $39.89 American, up to $44.16 over the past year. We ended up 11% upside return and total return of 13% return. What does Yum China own? So Yum China is kind of was a spin-off from Yum Brand. So right in terms of what they own in China, the biggest banner is KFC, right? But it's also Pizza Hut, Taco Bell, and then there's a bunch of local brands that we wouldn't recognize. But it's the largest kind of fast food operator in China, right? And the market in China is massively underpenetrated relative to, say, North America. And if you look at the business, it's just a phenomenal business. Like if you kind of go through, great business economics, good balance sheet, good management team, awesome growth, and great valuation. So I think this is one. Some people get hung up on this one. It's volatile. Like it's an emerging market stock. I was going to say there was quite a dip in last summer. I'm just wondering what hit it at that point. Do you remember? It's the threat that they were going to be forced to delist from the U.S., right? Like, so this type of stuff will keep coming up. Like, even saw stuff earlier this week. Hey, could the U.S. force all Chinese companies to delist from the NYSE? In the end, this is the governance on this company is best of breed, right? So I think in terms of a very, very unique exposure to China that's kind of self-contained within China, China looking to kind of stimulate their economy, people have to eat. They're a primary beneficiary of this. They have no debt on their balance sheet and almost $2 billion in cash. They've accelerated kind of their store build-outs. So this is a company that has massive growth profile, but it's going to flip-flop around. And I think you need to use that, in terms of, use that volatility to enter, because, I think when you look 5 and 10 years out, there's just a massive runway for growth there.
Okay, so it's something worth picking up right now. All right, let's go to your last pick from last year, which was Brookfield Infrastructure Partners. And at the time, it was 40.16. It has slipped to 39.74, so a 1% drop in return, but a total return up 4%. Tell me about Brookfield.
Yeah, so I mean, this one here, like especially even kind of keeping it positive, like that was, it's the dividend, right? Like, on a share price, it's pretty flat, but it pays a healthy dividend. This is a business that's massively undervalued, right? Like I think based on my estimates, price to fair value is about 70%. So, massive value in this name. So for people who are looking for income, but also companies that have the ability to grow as well, I think this is a wonderful opportunity to take advantage of in Brookfield. So this is one that I do like a lot and would buy here today.
Got it. Okay. On that note, we are going to take a quick break. And when we come back, Chris will take more of your questions. Of course, he's portfolio manager at Raymond James Investment Counsel. Back in a moment. Welcome back. Chris Blumas is here to take your questions today on North American large caps. The caller right now is Wakas. He's calling from Brampton, Ontario. Hi, what's your question today?
Hi there. Thanks for taking my question. So I have a GIC maturing of value 15,000 Canadian, and if reinvested will be at rate 2.25%. So what would be your call, either to reinvest in GIC or to invest in stocks in these days market, and which stocks to target? Thank you very much.
So good question because of where we are, right? He could get a lot of bang for his buck if he invests now with stocks the way they are, but it depends on how much he can take with the risk.
And I think the number one question, in this scenario, it's like time horizon, right? Because, okay, if your time horizon is really short, investing in stocks doesn't make sense.
So short as in a year or 2 years?
I think when you get out to, when you make any investment or any allocation to equities, I think minimum you have to be looking out 3 to 5 years, right? I think, even if you look at the market data, your odds of losing money in the stock market, beyond 5 years is almost zero. Right, if you can be in. So I think right off the bat, you got to tilt the odds in your favor, right? Buy things that are undervalued, buy them with a time horizon that allows you to stick in there. And I think, from time to time, this does come up. And this came up more in the past where GIC rates were really high. And people are like, okay, well, you talk to people, look, depending how you own a GIC, if you own this outside of a registered plan, that's 50% tax. So that 2.5–3%, the caller was talking about, that's instantly, that's 1.5%. That's below the rate of inflation. So you're actually losing purchasing power. And so I think, in the end, if you have a time horizon that's 3 to 5 years and you can use this volatility to your favor, you'd want to focus on some great compounders. And I can there'll be some kind of in the top picks, but because this can really set you up for a very, very long time. The price you pay determines your rate of return. If you buy right, you just need to, like we always on the show, it's 1 year picks. But I mean, if you look at some of these picks 10 and 15 years later, that's really where the big money is made. And I think that's where the GIC argument to me is too short-sighted. If you're thinking out 5, 10, 15 years, you can double and triple your money. That's how you grow your purchasing power. And I think you can do it with a lot less risk.
Got it. Okay, let's go back to the phone lines. Deepak's on the line from Toronto. Hi, Deepak.
Oh, hi. Thanks for taking my call. My question is about BCE. I'm investing almost for 20 years. Now, I know that it's the price for TV and internet every year. So what's the outlook for coming 3 years? Can it go up to at least $35, or it's all dead money right now?
Yeah, a lot of questions about BCE, of course, parent company, BNN Bloomberg under Bell Media's banner. Looking at it now, it's at about $30. It's been sliding under to 29. Do you think it has bounced back?
You know, this is one that when you look at, from my point of view, it's dirt cheap, right? And you know, if you look at the multiple, you know, it's around 10 and a half times earnings. You know, really what this is, you know, the market has lost confidence in this company. Like, this is one that's massively in the penalty box. And if you know, really the two overhangs on the stock are the dividend, and you can hear arguments, you know, that the dividend's going to get cut or the dividend's okay. If you look at the free cash flow the business generates, it's roughly in line with the dividend. So, you know, it's not as, if you look at relative to earnings, it looks pretty undercovered. But, you know, I think, you know, if the dividend were to get cut, that would actually be a positive catalyst for the stock. The stock will actually go up, I think, on the dividend cut. And then I think if you look at the U.S. expansion plan, you know, this is something that came right out of left field that caught people totally off guard. And really what it's going to do to the company is it's going to suck cash flow, because they're going to have to invest in this U.S. business. You know, is this what their shareholder base wants? Absolutely no, and that's what the stock price is telling you. This is a company that if it just, you know, people aren't looking at it for growth. If you just own it and said, hey, don't grow, but maximize free cash flow and maximize that dividend, this would be a stock that trades at 15 times earnings. People own it for one thing, the dividend. You don't own BCE for the growth. There's very, very little growth there, but it's a cash cow. And I think if you play to your strengths, you know, and management kind of retrenches a bit, I think there's a path to getting a better multiple back. And I think there's just really little downside here. So I think, you know, if you're looking for income, I think this is one you definitely want to buy here. That said, I don't own it, right?
Got it. Okay, let's go back to the phone lines. Ron's on the line from Montreal with his question. Hi, Ron.
Hi, thanks for taking my call. I'm wanting to start a position in CN Rail, CNR.
Yeah.
And I'm wondering if it's time to get in, or if there's still a lot of downslide to come. Thank you.
Let's have a look at CNR, and we can have a look at where it's at. And on that downward slide over the year, what's your take?
Yeah, so I think, you know, with CN and CP, you know, they've been negatively impacted by trade, right? And in terms of, you know, economic sensitivity, you know, they're definitely negatively impacted there as well. I think these are two businesses that I do like. Have owned both of them in the past. Don't own any of them now. You know, earlier this year, I did own CP. I think for me, it was just with kind of the unified kind of footprint across North America and then into Mexico. It just, to me, has the most advantageous footprint. And then with their integration of their most recent acquisition, there's some cost cutting that they can do there as well. So I think, you know, it had the most earnings upside, you know, from my perspective. I think the uncertainty kind of around trade, that's a shorter term issue, like say over the next, you know, certain amount of years. I think longer term, it's a wonderful footprint. The thing is, I think, you know, I would just look for a little bit more weakness and look to add to this on a little bit of a pullback.
So not necessarily buy now, maybe watch and buy, because in the long term, it will go up.
It will. In the long term, like, they're both phenomenal businesses. They're essentially, you know, the industry structure is super, super attractive, right? And so the margins and cash flow are great. They don't have a lot of avenues to reinvest because, you know, you can't build anymore and you can't buy anymore. So, you know, these are going to be cash cows. The thing is, it may take a little bit longer, you know, for them to harvest the fruits of their labor. And I think that's where you have a little bit of time on this. You don't need to rush out, because even when you look at, you know, volumes and trade, you know, things have been slow to adjust because they can't. You know, supply chains have to keep going and the tariffs will just get paid. But longer term, things will adjust. And I think, you know, regardless of how they adjust, they'll still be a beneficiary. Either way, you know, things need to move. Either they move, within North America and get to the ports and get out, or they move within North America. So I'm quite constructive longer term, but I think right now it's a watch and wait.
Got it. All right, we are going to take a quick break, but we will be back with more of your phone calls in a moment. Stay tuned. Welcome back to Market Call, and thanks for joining us. We want to go right back to your phone calls. Nazar is on the line calling from Toronto, Scarborough, Ontario. What's your question today?
Oh, hi, Marilla. Hi, Chris. May I have your thoughts on Sun Life Financial, please? This Life Co. has extensive worldwide operations. Will Trump's tariffs not have a substantial negative impact on its Asian operations, especially China? Sun Life fell from a 52-week high of $88 to below $80 now. Would it be better to switch into a Canadian banks like BMO, which has also fallen in the last little while? Thanks for taking my call.
Talk to me about exposure by insurance companies like Sun Life in this climate.
Yeah, so I mean, always the positive for Sun Life was like the emerging market exposure, right? Like they have big exposure to India and they have big exposure to China, which that was always, viewed very positively because it helps to propel growth, right? And so if you look at the life insurance market in kind of North America, very mature, not a lot of growth. So, the positive always for Sun Life was that, it had this emerging market exposure and that was what drove growth. And I think, that's kind of flipped a little bit against it right now. But I mean, it's a very well-run business. It's not a name that I own. I would put this one in the bucket. Like this is an income name. If you're looking for income, the banks, the life cos, the more mature, larger cap financials, this might be one you would consider. The one I own in client portfolios and I've owned for quite a while is Great-West Life. It's a slightly different focus. It's a mature market focus, on North America and then mature parts of Europe. And I think in terms of that growth profile, I quite like their acquisition strategy better and then their growth profile. So that's why I'm in Great-West Life versus Sun Life. I think in terms of, switching between life insurance and a bank right now, all of these businesses will be impacted by tariffs, just not directly, right? Like anything that provides a service. So banks, life insurance, they all provide a service. You can't tariff a service. But tariffs impact the economy, which impacts financial markets, which impact life insurance and asset management. So, they're not immune from it, right? It's the same as software. Software is immune from tariffs, yes, but if the economy's not doing well, businesses are...
It's a knockoff effect.
It's a knockoff effect. Yeah. So I think, in terms of their direct exposure, you don't have to worry. In terms of the knock-on impact on the economy, they won't escape it, right? Like, that's why they've sold off. But I don't think in this case, like, there's any cause for concern. Like, I think Sun Life's a good company, very well run, has an attractive dividend yield, So if it's one that you own, I would just sit tight here.
Got it. Okay, let's get back to the phone lines. Anne's on the line today from Scarborough, Ontario. Hi, Anne.
Good afternoon. Chris, currently my holding in Agnico Eagle Mines is only 7% of my portfolio. At this price, would you recommend buying more? Thank you.
Okay, let's have a look at Agnico is at 169, so they're on an upswing, which is kind of nice. What do you see sort of moving forward? Should you still buy in?
No, absolutely not. I think the valuation here is, it's great that you're there. It's great that it's a significant portion of your portfolio. So it's done great diversification for you. Don't chase this. It's done what it needs to do in your portfolio, which is go up, right? And it's gone up at a time when other things have gone down. So this would be one, momentum is on your side. The valuation is very, very rich. So it's not one that I would look to buy right now. But if you own it, I would continue to let this one run, right? It will continue to provide you protection as more people shift their allocations to gold. But I don't think you want to chase it on the valuation, right? Like it's momentum is on your side, so just sit tight.
All right, let's get to one last caller before break. Sal's on the line from Toronto. Hi, Sal.
Oh, Well, hi. Yeah, my question's on WSP Global. It's a lead in engineering services, and I thought this might be a good play in terms of the tariff rollout that's happening around the world. I was wondering your thoughts on WSP Global, and do you think this is a better pick than some of the other peers in its space, like Stantec or Atkins Realis? Thanks so much.
Okay, thanks for your question, and we'll turn that over to Chris.
Yeah, so, this is a really attractive name, right? So I think, the two that I would consider in this space are WSP and Stantec. I'm largely indifferent between the two. SNC or Atkins Realis now, I wouldn't look there. I think, what you get with WSP and Stantec is pure design, and so pure design is on the kind of the front end, before projects are even built, you have to design them first. And, they're both global. And I think, where I lean a little bit more towards WSP, the valuations come down dramatically. So I think, this is one that's trading right around 27 times earnings. It's still not dirt cheap, right? But I think it's a fair price to pay for a very, very well-run company. They're highly acquisitive, and they're backed by, the two largest pension plans in Quebec. So I think in terms of them being able to consolidate in a really tough economic environment, they have the firepower, and they'll likely benefit, even if their stock price weakens because there's lots of turmoil. I think this is one you definitely want to consider buying.
Got it. Okay, we are going to take a quick break, and that is all the time we have for your phone calls. But our guests' top picks, new top picks, coming up next. Stay tuned. Welcome back. Chris Blumas is our guest today, and he's sharing his top picks, his new top picks. He's starting out with Brookfield, BN on the TSX. What do you like about Brookfield, Chris? Yeah, so today I deviated. Typically what I do is I like to have one U.S. name, a Canadian name, and an income name. And so I think today, I have three Canadian names. They're all compounders. And I think, this is kind of, in the face of all the volatility in the market, and people are looking for, really, really high quality things to take advantage of in this environment. I think Brookfield's is just a phenomenal company, right? And I think in terms of them being able to benefit from this environment, they have roughly $160, $170 billion in client capital that's ready to be invested. So, as economies around the world go into shock, businesses that are on less stable footing come up for sale, Brookfield is so well positioned to benefit from this. And then you as a shareholder, they have lots of things they can do. They can buy back shares, their own shares. They can do opportunistic acquisitions, which they always do in down markets. So I think this is one where, it's a very easy way for you to be counter-cyclical. You invest in a company like Brookfield, you can sleep at night, and then they'll do the work for you. Got it. Okay, let's go to your next top pick, which at this point is Couche-Tard, which has been in the headlines quite a bit lately because it's trying to buy the 7-Elevens from the Japanese company that owns them. And they've gone quiet a little bit lately, but there is a big push by Couche-Tard here. There's a big push, and Seven and I has kind of come to the table, and they've been making some progress. We talked a little bit on the break. I don't know how this is going to play out. My investment thesis doesn't hinge on them completing this deal. I think if they win this deal, I think it's a massive win for shareholders, depending on how it's completed. They're just so much more efficient than everyone else. And if you look at Seven and I's U.S. operations, the margin profile isn't comparable. So there's a lot of gains that Couche-Tard can kind of reap there. And so I think this is one, like, if the deal goes through, you're likely a winner. If a deal doesn't go through, which I'm in the camp that I just think it's not going to go through, they're off to something else. They're off looking for another acquisition in the U.S. They have such massive scale. There's going to be such massive consolidation, and it's such a fragmented industry. They're just so good at what they do, and so few other companies are. Yeah, and they seem very hungry to acquire. They are, and the thing is, they're good at something that basically nobody else is good at. And as they've gotten more scale, their margin profile has just expanded. They're super shareholder friendly. The business gushes tons of cash. They either buy more companies or pay down debt or do share repurchases. So no matter what happens in any scenario,
you're likely going to benefit over the longer term. And I think, at 17 times earnings, it's a very fair price to pay for a really well-run business.
Got it. Okay, let's go to your third pick for today, which is Constellation Software. What do you like about Constellation, CSU on the TSX?
Yeah, so this is one that I've talked about in the past. In all the years of me coming on the show, I think I've had it only once or twice as a top pick. It's not one that I'm able to buy that often. It typically trades at a very high valuation. I think, just with the pullback and the money flow out of tech that I mentioned, this is one that has come down as well. And so, my entry price here was 4,500. I have trouble buying this one as well, just because, it very rarely sells off. So, I leave a limit open for this one, and on the really, really volatile days, it tends to get filled. And so I think, clients, I think viewers should utilize the same approach, right? I get a lot of times people ask, okay, what was your entry price? The buy price is right there. I think, you'll do very well, kind of buying at that level. And I think this is one that you definitely want to own for the longer term.
Yeah, and it's upwards of 4,600, almost 4,700. I guess today. So if you have to have some back pocket money for that. We do have to leave the conversation there. Chris Blumas, thanks again for joining us. Thanks for coming in today, and we'll see you again soon.
Thanks for having me.
And thanks for joining us here on Market Call. A quick look at the markets as we head to a break.